All right, so we're going to go ahead and kick things off post break here and resume the sessions. This one is on managing your portfolio through extraordinary uncertainty. In conversation on stage will be Meeterine Keating, the CEO of BNY Mellon Wealth Management, and Matt Brown, the founder and CEO of CAIS. I welcome you both to the stage.
Shall we?
Yes, I think we shall.
Wonderful. Hello, Catherine.
Hello, Matt.
How are you?
Good. Much better meeting here than in New York City.
Very true.
Right where we are.
Well, we may be the only two New Yorkers that haven't moved to Miami. You know?
Yet.
Uh-oh, are we an endangered species?
I don't think so.
There is definitely a tidal wave of transition from a lot of cities to Miami.
For sure.
So it's great to be here, everyone, and I couldn't be more honored to be here with Meeterine Keating. My name is Matt Brown. I'm the CEO and founder of CAIS. CAIS is a technology platform that connects alternative investments with financial advisors everywhere. And I couldn't be more honored and thrilled to have a conversation with Meeterine Keating. Catherine is the CEO of the investment solution and wealth management business at BNY Mellon. The accolades are endless of your career. The top 100 women and influential women in finance, amongst many others. I thought what we could do is, why don't we just begin with a little bit of your journey? And you're sitting now as the CEO of a major wealth management company. Nothing in life is easy. As an entrepreneur, I can give you all the war stories, but even inside of big corporations, you have to act like an entrepreneur. Right. So tell us a bit about how you ended up at the top of the pyramid at BNY.
Well, you're very nice to ask, but my journey is probably the least interesting thing that we will talk about today. But I think there are a couple of important points. One is the visibility of finance as an industry. I think it's growing, but I grew up in Washington, D.C. It never occurred to me to go into financial services, asset management, wealth management. I didn't know anybody. Growing up in D.C. back in the 70s, you saw law and medicine and journalism and public service and real estate and wonderful careers. I didn't know a single person. My dad was a lawyer. He died when I was a little girl. I made a decision that day, I think I was 8 years old, to go to law school. That was the one career I'd seen up close and personal. And it wasn't until I graduated from law school and had the great good fortune to work with asset management companies, and one in particular, Vanguard. Vanguard was very, relatively new company, founded in the 70s, but in the 90s when I knew them, they were counting their assets in billions, not trillions. And Jack Bogle became a mentor, and I realized that I was much more stimulated by markets, which change every day and sift information, than I was by law, which changes very slowly. And so, and I also was very appreciative of the mission of being an asset manager or a wealth manager. Whether you're managing money for a pension plan and retirees, or for a nonprofit that might provide education, healthcare, culture, or individuals. It really is a mission of trying to give people better financial futures. So that's how I found my way here.
Got it. And did you actually go to law school, or did you bypass that?
No, I went. Oh no! I went to law school. I got a degree. Yes, I got a degree just to not use it and go into asset management. Yes, I did.
Well, that is. I'm sure there's a lot of stories in between that moment and where you are today, and we look forward to learning more about that. But Catherine, we have you, and we only have you for 25 minutes. So, what I want to do is just really dig into wealth management. It's such an evolving industry. I started my career as a wealth advisor, a financial consultant, ended up in the alternative investment space, so I've had a close seat in this journey for quite a while. How has wealth management changed over time? How does that impact the individual investor, the economy?
Yep. So if I think about my time in the industry, starting out in wealth management, going to asset management, coming back to wealth management over, sort of the last 20, 25 years, and I think a few things have changed. The first one is that the demographics have changed, right? And we wrote our 2020 investment outlook, and that was one of the themes, right? Demographics changing all around the developed world. You see all the major economies in the world aging, the US, Europe, China, Japan. And demographics are really important to economies, because what tends to happen as economies age is the GDP growth slows down. We actually haven't seen that yet. We haven't seen that in the last 2 years, surprisingly enough, despite the pandemic. But we do think it's going to be an important marker for the future. And then the second thing that's really changed, again, over the course of my career and probably yours, is how we save for retirement in this country. 25 years ago, if you worked at a public company or any company, you probably retired with a pension plan. That's no longer the case, right? We now save for our own retirements ourselves in our 401k plans and with our personal savings. And that's been a major, major change. It means that wealth management, I say, has gone from being an and, you have your pension and your wealth management, to an it, right? We really, in our industry, are responsible for securing people's futures, of course, working with them. And then the last thing that's really done is it's changed market structure. So if you think about markets today, we talk about the fact that consumers are 70% of the economy, but we don't really talk about the fact that individual investors actually represent 70% of financial markets in this country. If you look at personal savings, over half of the households in this country now own stocks. And then you add in the 401k plans that we control ourselves, right, through our investments in 401ks, that's really 70% of financial markets, and that's a major, major shift in market structure.
I want to go back to demographics just real quick. So you said demographics are changing. What exactly is changing, and what's the impact of that change?
Yeah, so the real thing that we've been focused on is just, as I said, aging across the world's major economies. And if you look at this country, in 1970, the average age was something like 28. We are going to be an average age of 40 very quickly in the next couple of years. And so, again, if your average age is 40, it just means you have a lot above that. And as economies age, as people age, as they go out of their income-producing years, you tend to see GDP growth go down. And when GDP growth goes down, you tend to see lower returns in the markets. Again, that was our forecast, starting this decade in 2020. It hasn't quite happened yet, but we do think it's going to be part of the future.
Got it. And then now you're thinking about the individual investor. And some are saying, I guess that segment is now even larger than the institutional.
It is larger and faster growing. Yep.
Wow. Are there practices or lessons learned that we can take from the institutional community and bring to the individual investor?
The answer is yes, and we are very, very dedicated to that at our firm. You think of Bank of New York Mellon, we're a deeply institutional firm. We work with institutional investors, day in and day out, and our mission is to take the disciplines that have made institutions so successful over time and try to bring them over into the wealth management business. And so what have institutions done really well? Well, the first thing they do really well is they know what their goal is. Right? You're a pension plan. What's your goal? To have a portfolio that's going to be able to pay all those retirees. You're your college endowment. What's your goal? You've got to pay out 4 or 5% a year, to support, your university. Nobody tells us what our goal has to be. We have to figure that out for ourselves. So is it a certain amount of income in retirement? Is a certain legacy that you want to leave for children or maybe for philanthropy? We have to decide what our goal is. But once we do, then we can follow the practices that institutions do, which is they develop an investment policy statement that'll help them achieve their goal. And the reason I mention that is what you find is that policies protect you. And I'll give you a live example. I was on the board of my college back in 2008. For whatever reason, my college board meetings are often on Monday holidays. So we were meeting on Columbus Day. It happened to be the day in 2008 that all of the bank CEOs went to Washington to get TARP money.
Yep.
So here we are in our investment committee meeting, looking at all the bank CEOs lined up to get TARP money. And our portfolio, of course, had a big downdraft, and we'd done a lot of work on our investment policy, and we knew the right thing to do was to rebalance and buy equities while the market was down. I have to tell you, it's a really hard thing to do, but when you've done the work on your policy, you sort of link arms with your committee, you do it, you buy, you rebalance, which proved to be a very good decision, 6, 9, 12 months out. But individuals don't have to do that. And in fact, what we saw in the financial crisis is that individuals didn't. They didn't. In 2008, what happened? Because we can sort of figure out what the individual investor does by looking at mutual fund and ETF flows. And what the individual investor did was they sold equities.
Right.
They plowed $1 trillion into the bond market, and then they stayed there for 3 years. So they missed that whole snapback that comes, when you get to the bottom. So, the good news is, as we are following fund flows, they did much better in 2020. They didn't necessarily rebalance. You didn't see the investors when the market went down, dramatically in March. They didn't necessarily rebalance, but they didn't sell either. They just waited until 2021 to come back into the market. So they lost some of that upside, but they still got a very good year last year.
Well, I think it sounds great to invest as an institution, as an individual. The first thing that comes to mind as someone in the technology world or the fintech space, how could you possibly scale an institutional process that's done for a large institution down to an individual,
Yep.
and how can that be really impactful?
So this is the single biggest challenge and opportunity for the wealth management industry, because if you think about it, when you're investing a pension plan, you've got one big pool of money that you're managing for all of those employees and retirees. If you're managing a sovereign wealth fund, you have one big pool of money that you're managing for all of those citizens. The problem when you come over into the wealth management business is you've got literally hundreds of millions of people that you're investing for. And so you absolutely need to come up with a framework and technology to scale that. Because if you really think about our industry, the way the industry has scaled is with product. I launch an ETF or a mutual fund or a private equity fund, and everybody gets the same fund. No product is going to guarantee an individual investor's success, right? You can't get there just with product. You need advice. And advice takes into account all sorts of things. How old are you? What's your risk tolerance? What's your long-term goal? What's your tax situation? A whole bunch of things. And by the way, they change over time. And so what we found is that you absolutely need to have a framework. We built our own. We said there are really 5 things that an individual needs to focus on to secure their financial futures, and only one of them actually is the investment portfolio. That's very important, obviously, investing in your portfolio. The second one is borrowing, right? Borrowing's a choice. We learned in the financial crisis that you should borrow prudently, which is often less than a bank will lend you. The third one is spending. Every institutional investor has a spending policy. They know what their cash flows are. Nobody requires an individual to have it, and yet it's the one thing you control, and it has a very big impact. The fourth one is managing after-tax returns, because again, the industry grew up in the tax-exempt world, right? Big pension plans or 401k plans, and our own holdings, we pay taxes. And then the fifth one is protecting what you have. That's everything from good insurance to estate planning, and those are the 5 things. And if you just continuously, revert back to them, they will really help sustain your success. The problem is, with many, many, many clients with slightly different, goals and ages and tax situations, you have to have technology to do it. And so we built our own tool. We call it Advice Path. It integrates those things. And we really do think it enables us to bring institutional precision and discipline to individual investors.
So in a steady state, I'm sure that's great, but this year has been anything but steady state.
Yes.
So we have rising inflation. We have, hopefully, fingers crossed, the COVID crisis winding down. You have a geopolitical risk with Russia and Ukraine, and that seems to be going from terrible to catastrophic by the day. How do you think about navigating times like this, where things aren't just going, up and to the right?
Yeah, so there's no question that we're starting the year facing some really, I would almost call them historic developments, right? We are coming out of the worst health crisis in 100 years. We are now facing the worst ground war we've ever seen in Europe in 80 years. We all know, we read it in the headlines every day, we have the worst inflation we've had in 40 years. And we probably have, at least in my lifetime, we have the tightest labor market we've ever had. But the context of all of that has to be, what's the ecosystem that we are operating in, right? What's the economic ecosystem? And this was a recession in this country like no other. If we all think back to the financial crisis, what happens at a recession? People lose jobs, incomes go down, spending goes down, right? You have this big contraction. And what we saw here was this wasn't a typical recession. This was a health recession. We went into it with a very strong economy, very strong companies, very strong consumers. We talked about that in some of the earlier sessions today. And what you really had here was a health recession. 60% of the global economy shut down in a single month, March of 2020. And it was followed by pretty coordinated actions by central banks all around the world, none of whom did as much as ours, right? $6 trillion in fiscal stimulus pumped into the economy, 26% of GDP. And what it means is that, unlike every other recession, incomes never went down. Not in any quintile of the income stack did incomes go down. So that strength of companies, consumers has only been increased, right, through the actions of central banks. So there's no question about the fact that we face challenges. There's no question about that volatility is back. We see it in equity markets, bond markets, currency markets. But there's also no question about the fact that we haven't seen what we would call normal volatility lately, right? Because the S&P 500 has doubled over the last 3 years.
So when you think about the strength of America, I think that's kind of where you're going here. Despite all of this, America is strong. You would agree with that statement?
I would agree with that from the perspective of the economy and banks and
Correct.
capital markets and all of that. I do.
And just what are some of the reasons why you think that despite what's going on, the U.S. is strong and going to continue to grow, and how does that translate into confidence on how you advise and invest for your clients?
Yes. So as I said, we're facing some, really significant, I guess I would call them headwinds. But again, in the context of an ecosystem that was actually really quite strong. And I guess what the things that we are really watching very carefully, because our base case going into this year before the invasion of the Ukraine, our base case for the year was positive economic growth, but slowing, positive earnings growth, but slowing. Inflation, we never saw it as transitory. We always called it transitional, meaning we never really thought it was going to get back to 1 to 2%. We thought it would settle more somewhere between 3 and 4. And the thing about that is, yes, we haven't had it recently, but in my career, that's normal. That was the kind of the normal inflation rate, right? It was 3 to 4%. The aberration really seems to be the last decade. And markets can do just fine with 3 to 4% inflation. Companies can raise prices, they can raise wages, consumers can afford to pay it. So that was our base case. And what you've seen so far this year was, first of all, the market, realizing that inflation was higher and for longer than anybody expected. So getting ready for the Fed to tighten. That's what initially started the declines in January and into February. And then, of course, we've had this invasion of Ukraine. And so the thing, which is first and foremost a horrible, horrible humanitarian tragedy where we see, civilians being targeted, not accidentally, but intentionally. It's absolutely horrifying. And so the things that we're really watching to see how our base case, might change. The first one, obviously, is inflation. It's important to everything, absolutely everything. The second is, of course, geopolitics. And what we're trying to assess in this particular case is this what we would consider a kind of a geopolitical event, right? Because when it's an event, markets tend to react and respond very quickly. So if we think about 9/11, geopolitical event, markets shut down, have a big downdraft when they reopen. That downdraft was recovered within 2 months. The problem was, again, you're always investing in the economic ecosystem that you live in. At that time, we were investing in an economic ecosystem that had already been in recession, had already been in a bear market, and was a really slow U-shaped recovery that lasted until 2003. So again, if we look at today, if this is a typical event that's a surprise, but then the surprise dissipates, we can get through it. If it becomes a more wider spread conflict, something like the Gulf War, which lasted the better part of a year, then it takes longer. I don't even want to contemplate right now something that could be worse. So we're definitely looking at that. You mentioned confidence.
Yeah.
We absolutely look at confidence because it's people's behavior and the changes in people's behavior that actually lead to a recession, right? If people are contracting, and when we look at confidence in this country, consumer confidence, small business confidence, CEO confidence, all peaked, sometime in the middle of last year. It's come off and it's continuing to come off. Not dramatically, but noticeably. So we watch that, and then the last thing that we're really trying to watch, and this can be the hardest one to find, is we look for where there could be leverage in the system, right? And we saw, when Russia defaulted back in 1998, we realized the leverage in the system was in highly leveraged currency bets, long-term capital management. In 2008, the leverage in the system, you could argue in hindsight, was hiding in plain sight. It was the mortgage market.
Right.
So we're looking, and the reason we look for that kind of financial leverage is that can spread and be contagious. And so, so far, obviously, seems to be some leverage in the commodity markets, metals markets in particular. But we're watching that very closely because that's what can really lead to a more substantial downdraft.
So we all know things last longer. Crises go on longer. I can remember back in March, April 2020, and we're like, well, this could be a few months with this COVID thing. And now look at it. Conflicts spread. Decisions are made irrationally sometimes. So how are you positioning precisely client portfolios for various scenarios here? China, of course, is keeping a very close eye on Russia, on how this goes. They've kept their eye on Taiwan for quite a long time. Our withdrawal from Afghanistan didn't help the narrative. So there's openings for this to spread. Inflation can continue. What is the defensive game plan of BNY right now?
So I would say it's a combination of offense and defense. And the reason I say that is, remember, if we're saving for our retirements or maybe even for our children, in the many years into the future, time is actually, as an investor, our biggest asset, because over time, markets, you might have some volatility, but over time, the gentle upward slope of markets, across decades is really pretty important. And so, just as an institutional investor would do, we do stay invested. That doesn't mean we don't overweight and underweight. We absolutely do that. So right now, if you looked at our portfolios, you would see that we have removed the overweight to equity that we'd had for, actually, I don't even know how many years. We had it many years in a row. We took that back to neutral this year, which means we're still invested in equity markets. But if your neutral is 60%, we're going to be at 60%, not higher. We have underweighted fixed income markets for the obvious reasons, right, with rising rates, in particular treasuries, because of the strength of corporate America and actually municipalities. The mayor was very compelling, but most municipalities in this country actually are running big surpluses today because of all of the government stimulus. So we are overweighting credit within fixed income a little bit, investment grade or high yield municipals. And then we're looking at alternatives, the kind of work you do, right? The things that diversify your portfolio, absolute return hedge funds, that sort of thing, to give you, some extra ballast that you might not be getting from fixed income.
So CAIS, as you know, is a platform, and financial advisors access private equity, venture, real estate, equity and debt, private credit. Tell us how you're thinking about incorporating alternatives in a moment like this. Are allocations going up? Is client interest inbound? How are you thinking about implementing alternative investments across the board?
So your question, Matt, reminds me that I think we're both engaged in our own way in the mission of bringing institutional disciplines and products to individual investors. So if we all have to invest for our own financial futures, our portfolios ought to look more like institutional portfolios, right? They should have exposure to private markets, and private markets have developed, I don't have to tell anybody here because I know where many of you work, have developed extraordinarily rapidly over the last 20 years. So you think about private equity. Why would you invest in private equity? Because historically, if you invest with the top 2 quartiles of firms, you have earned a liquidity premium over public markets. And if we're thinking that we're going to have lower returns in the future because of demographics and other things, you really want to secure that return. And we look at private equity markets, we've seen a steady decline in the number of public companies in this country. We have many, many more companies now that are backed by private equity firms and funds than are standalone public companies, and these companies are staying private longer. So what you see is if they do go public, and we had a discussion earlier today about M&A markets and things like that, they often go public as mid-cap or even large-cap companies, not small-cap. So you really need to be invested in that fast growth stage, which is often in private markets. We also, private credit is now actually quite a mature market, 25 years old. We look at that as another way to pick up some extra yield in a low-yielding fixed income market.
How do you get your clients comfortable to take the illiquidity risk?
It's a lot of it's education. It's education. Now, recognize that most of our clients are business people, so they they might be running their own business. They are a private equity investor in their own business.
Right.
Depending on how illiquid their business is, they may prefer to have more liquidity in their portfolio. But again, we tailor it to their objectives, and we try to show them, this is how the Yale Endowment does things, or your college, whatever one. Now, they have some advantages that you may not have because they have, fundraising campaigns, annual giving, cash flows coming in all the time. Not everybody has that, but we try to input those institutional disciplines to help them get the institutional results.
Well, we only have a few minutes left. I want to just switch gears slightly. You and I had a conversation at the Milken Institute around the impact of COVID that we've all felt in our businesses. At CAIS, we've seen financial advisors, across the board embrace technology in new ways, embrace virtual communication. That's speeding everything up for them, looking for technology to create efficiency. What are some of the impacts that COVID has made for your business, for BNY, and where do you think, what changes will stay, what will kind of revert back to the mean?
Yeah, so I think it's really had two big impacts. The first one is how we interact with our clients. Because historically, you would have in-person meetings, and we remain a very personal business, many in-person meetings, and then you'd impact digitally, right? Things people could do online. We've added a third leg to that business model, which is virtual, and that's going to remain. That's going to remain, right? It's become so convenient. It's not going to substitute for in-person meetings, but I'll give you an example. On Friday, I met with a client family of ours. The wealth was created in Europe, so there are family members in Europe. The rest of the family is spread out from California to New York, and sort of everywhere in between. And we had a big family meeting. This family has been clients of ours since 1989. And we had, the European folks virtual. All the U.S. folks pretty much came in, from around the country. And I think that's here to stay, right? It's just so efficient. It does work. We've learned how to use it. But I think the real thing about technology is what I said before. You cannot scale advice to many different clients, all of whom are different, and by the way, might change, from year to year even. Like, they don't even stay the same. Once you learn them, they still change. You cannot do that without technology. And a lot of the technology tools that have been developed historically in the industry have been developed, not surprisingly, by asset managers. And they're quite capable when it comes to portfolio management and analytics. The thing is, that's just not, portfolios alone won't get you there. When we look at those 5 things, invest, borrow, spend, manage taxes, protect what you have, the portfolio only drives 40% of your success over time. The other 60% is from these other things. And so we just concluded we had to build it ourselves. It's been a lot of work, but we actually think the other thing that I think it does is, historically, in the financial services industry, I think sometimes clients thought the plan was the financial advisor's plan. Here are all the things you told me, here's the portfolio you should have. The wonderful thing about this tool is it can become their plan, because you can sit in a meeting, and I did sit in a meeting once as we were beta testing this with a husband and a wife, and their goal was to leave a certain amount to their children at the end, and it turned out that the chance of them achieving their goal was less than 50%. And I remember the husband saying, I think we need to take more risk in the portfolio. And I remember the wife saying, no, I think maybe we need to spend less money, right? So I mean, it gives you, you have the ability to toggle between different tools, to achieve your objective.
Catherine, we're out of time, so I'm going to give you one last question, kind of a fun one for the group. Share the best advice you were ever given along your journey.
Oh my gosh, the best advice. Okay, be yourself.
Be yourself.
Be yourself. And when I joined this industry back in the 90s, anyone who was here at the time will know that you women in particular were not encouraged to be yourself. You were encouraged to wear the exact same kind of suit that a man did, and not only that, you were supposed to wear a bow tie around your neck instead of a regular tie. And I'm proud to say I never wore a bow tie around my neck. But be yourself, right? Be yourself. It's too much trouble to try to be somebody else.
Great. Thank you.